Good. Well, good evening, everybody. Welcome to the December 2024 Investing Roundtable. This is the last one of this particular year. It's been a good year for us in the stock market, and I'd like to welcome to the panel this evening Betsy Wills from the Rocky Mountain chapter. Betsy was a guest on one of our bull sessions, and we've invited her to present tonight at the roundtable. We have one of our regular nights back with us tonight, Cy Lynch from Atlanta, and then Mark and I will join you with two picks that we've talked about before, but we think that they're probably a little bit undervalued, and we think that they're compelling ideas at the particular moment. We're sitting in the hot tub enjoying our Vernors. For those of you not from the Great Lakes area, Vernors is a local ginger ale, and Vernors is quite popular. They brought out a couple of new flavors that aren't nearly as good as the original, in my humble opinion. But all the way back to when I was a child, I can remember my mother making us hot Vernors with a lemon slice in it for a real treat on a cold winter's day. So that's something that we can enjoy sitting in the hot tub there.
Yeah, a little back. I think we should give a little background on the tub. The tub, it actually is a reference to tailgating, known as tub gating. There's actually a group of people that actually drive in
Mark, excuse me, you're really breaking up an awful lot. I don't know if you have a short in your cord or something, but try not to move your cord and let's see what happens, okay?
I will sit back, and is that any better?
Well, you didn't break up, so let's keep going.
All right. Well, the tub gate actually refers to Detroit Lions fans that actually pull up a hot tub behind their RV. They tailgate using this tub in the parking lot. So we just made it a big merry party here tonight.
Well, let's get started. We have our normal disclaimer. And folks, I'm not going to spend more than 8 seconds telling you that everything we do is for educational purposes. We don't expect you to go out and act on anything that we talk about, because we're not giving you recommendations to buy, sell, or hold. Do your own homework and make your own decisions. We have great confidence that as an investor, you're able to do this without following blindly anything we might say. We will try to disclose if we own any of the stocks that we're talking about in our own portfolios. And we are recording this session and we'll be posting it on YouTube for posterity's sake, along with about 14 years of these programs that we've been doing and posting and actually getting people to take a look at them. So we're quite pleased at that idea. If you'd like copies of the actual slides, send a note to Mark R. at manifestinvesting.com. If you'd like to ask a question of either one of us, those are our email addresses, and we'd be glad to communicate with you and try to answer any questions or concerns that you might have. If we move on one more slide. We pulled together just some really interesting things, because we're not going to take a lot of time at the front end of the program tonight. We're going to try to get right into our presentations so we can get our Lions fans back to their TVs watching the game this evening. Mark went through all of the roundtable picks, and he chose the 20 oldest live selections. In other words, these are selections that we have not decided to move out by freezing them or, quote, selling, unquote, them from the portfolio. These are still live. They're still counting as things that we think are interesting ideas. And you can see they go all the way back to 2010. The oldest one on the list happens to be giving us the largest market return. You know, I'd settle for a 14% return on any particular stock that I would have in my portfolio. At the moment, it's losing to the market by 2 points over that 14-year period of time, a little bit longer than 14 years actually. But all in all, I think it's done fairly well. SEI Investments you might take a look at it. I don't know how it looks today because it hasn't been in my portfolio for the last 5 or 6 years. You can see the list is dominated by Cognizant. We've chosen Cognizant quite a bit. And they are some of our oldest holdings in the portfolio, along with our largest holding, which is Microsoft. We started putting Microsoft in the portfolio in 2011, and we continued all the way through 2013, placing Microsoft in the portfolio. I don't think we've purchased it since that point. Am I right, Mark?
I don't believe that we have. So those are the 5 individual transactions or decisions made with Microsoft. Now, Ken, I thought you'd really enjoy that old English font up at the top. Getting pretty festive here.
Yes, we are. We just need to pull out the grog and the falalas, and we'll be all set. Okay.
I just get a kick out of it. Pretty good distribution with all of those selections are over 10 years old and still active positions. And more recent history, this is just the last year. And there's one particularly disturbing element to this chart. You can probably guess what it is.
Shall I point it out, Mark, or are you going to point it out? We might have lost Mark's sound completely. I don't know.
No, I'm just going into hiding.
Oh, you're hiding. Okay. There's no Robertson on this particular list right here. Although I do thank the folks that have gone with me for a number of stocks on this list. When you see my name and then you see audience right next to it, that's times that you voted for my stock. And we seem to be doing pretty well in the past year, folks, with Technoglass and Globus Medical and XL Services. And you didn't go with me on Iradimed, folks, but it was a goodie. You should have picked it. So these are the best performers in 2024 here. Going back to actually our fiscal year kind of runs November to November, so we're choosing starting with November there with that NVIDIA pick by Herb Lemkohl.
I think it's cool. Checking in there with Lululemon. We can't pay so not.
I know Ann is in the audience tonight, and Ann, you should be completely happy with your Lululemon pick. I picked it at a couple different panels as well, and I'm sitting real pretty with my Lululemon picks as well, even though there were a lot of people that gave me a lot of notes telling me that I was off in the deep end with choosing Lululemon when I chose it. So the numbers just seem to prove them wrong. A 33% relative return for any stock is nothing to sneeze at.
Well, virtually everybody's on here but me. I mean, Candace Baker on there.
Mark, I don't know what's wrong with your sound, Mark, but we're hearing only once every 5 or 6 words right now. Maybe you can plug it into a different port or something and see what happens.
I will try that.
All righty.
Wonder if I can go hardwire on the headset.
Could you give us another slide while you're fooling with your sound there? We'll talk about it just real quickly because we want to save plenty of time for our presentations.
Or just talk about Mark.
All right, we could do that too, Cy. All right. Here's our rule of 5 disappointments, and we've only listed the top or the worst 20 of our disappointments, and all of us are on the list, so all of us can take a bit of time to a little bit sad or bow our heads or whatever we have to do to ask for forgiveness. But we do know that there are many times when we talk about a stock, we think it's a great idea, and then we turn on less than a year later, we notice that it's losing to the market by 25 or 30 points. I have a couple that I was really kind of feeling real good about, LVMH and Schlumberger both, but the market has not liked either one of those stocks since they were presented. And you can see that we have quite a long list here of rule of 5 disappointments. These might just be works in progress, by the way. We might be able to move them around towards positive as we get a little bit further into the timeline that we really kind of deal with for stock picking. These are short-term picks. They're all from 2024, but we like to say we're picking stocks for the next 3 to 5 years. So we have a hand in the air right now. We don't get a hand in the air very often. So let's take and unmute James and let James ask his question. James, go ahead.
So just was noticing Axcelis was purchased 3 times last March. I thought there'd be more separation in the buys.
Well, there is separation, but I think that Axcelis is just down there. That's just one of the buys down there on this list. Am I right, Mark?
That's correct. Yeah.
Yes,
Yeah.
there's 3 Gentexes in March.
Yeah.
I mean,
Yeah,
I'm not sure what the question was, but
yeah.
there's only one Axcelis in March. There are 3 Gentexes.
Right. I'm not sure that we're just showing the 20 positions that have done the worst in 2024 here. And it's not very hard to figure it out. We make mistakes, and we like to own up to those mistakes when we make them. So let's look at our performance here, if we can, real quickly before we move to our stock picking. Here's the round table since, well, we've been doing this for almost 15 years now. So we're looking at where we've been. Mark, I'm hearing a side conversation.
It's not me. You can go ahead and that's probably James still.
Okay, all right.
I'm having trouble doing my volume.
Let's see if I can get, okay, James there, I can get you muted again. Okay. He took his hand down and I couldn't find him on the list then real quickly. So we're beating the market right now by 4 points. Our goal is to beat the market by 5 points. 4 isn't bad, but we'd like it to be 5. That orange line across the graph is showing us beating the market as measured by the Wilshire 5000 by 5 percentage points. And we've been bouncing around that line now for the last, maybe 6 or 7 years. We're quite pleased to stay between 4 and 6. It's real happy when you go above 6. It's kind of sad when you go beneath 4 right there. So we think we're demonstrating that the process that we use, this idea of buying stocks when they're a little bit undervalued and then holding them for a decent period of time, I think we're trying to show that that works. And I think so far we are being successful in doing that. We'd like a outperformance number of about 55%, however. In other words, we'd like about 55% of our stocks to actually beat the market. And our outperformance accuracy, while it's been moving up just ever so slightly, it's still only about 44.5%, 44.3 to be exact. So we could get a little bit more accurate. If we could get Mark's name on that positive list a couple times, we'd be really in good shape. So,
I was just going to say, I hope you can hear me better now. I went to a hard.
We can hear you a lot better, Mark. Yes, a lot better.
Well, I guess I just had a weak connection here, but a few years ago, Warren Buffett in his annual meeting pointed out that if he had simply gone to the movie theater and not done anything with the portfolio, the Berkshire Hathaway shareholders would have been better off. And I think maybe that's my story for last year. Now, 2 years ago, I was red hot. So maybe I can get red hot again. But you take my picks out of there, we're probably back above +5 again. But
okay.
I'll try to do better.
We're getting a question, what's the difference between relative return and market return? Market return is how much the stock itself has appreciated. So the market return for this portfolio since inception has been 16.5%. So for the last almost 15 years now, the portfolio has performed at 16.5% compounded annually. The Wilshire 5000, which is a large scale index fund, has performed at 12.5% during the exact same time with the exact same infusions and withdrawals of cash to show us as a mirror to our own portfolio. And if you subtract those two numbers, then you find the relative return, how much you beat a suitable index. And for the last almost 15 years, we've beaten the index now by about 4 points, and that's compounded annually. Just to give you a rough idea, only about 12 or 14 of the index funds that we follow, not the index funds, I'm sorry, the mutual funds and ETFs that we follow, only about 12 to 14 of them have a relative return at 4 or better. So this is a really quite decent return, especially for a group of folks that do not consider themselves professional investors. We're hobby investors that happen to take it kind of seriously sometimes. And we think that we're fairly decent stock pickers over the long term. Mark, anything to add?
No, I would just second the thought that we as a community believe that it's possible to identify better companies with excellent potential, excellent management, and we wait for them to be on sale. And we show how we do that here. That's what we've been doing for years. That's what the community of investors known as Better Investing, the National Association, or Manifest Investing, that's what we have been doing for a number of decades. So it's really refreshing to see, four friends come together and generate this type of thing. And now it's four friends and 10 or 14 other friends. So it's really cool.
I do think, Mark, that we need to pledge to our audience and maybe in January and February to pay a little bit more attention to the management of this portfolio. And we might be taking a look at some of the companies that are in that portfolio right now with growth numbers, and that's sales growth numbers. Here's the top 20 holdings in the portfolio, and you can look at that sales growth column. It's almost in the middle of the chart. It just is titled growth. But if you look down there, we do have some companies that are growing a little bit more slowly than probably we'd like them to grow. And as companies grow their sales more slowly, then you can expect their par values in most cases to grow more slowly as well. So maybe in January, February, we'll take a little bit of time and do a little bit of work on maybe weeding and feeding the portfolio. What do you think, Mark?
I think so. I think Cy's ready to spring into action.
Yeah, I would certainly endorse that. I was muted a second ago about the portfolio or the performance, and I just wanted to mention one thing. You talked about the relatively few mutual funds that have beaten 4%, and that is a valid statement and certainly an important comparison. But I would also highlight that I suspect many of our attendees are aware of the relatively strong investor emphasis on index investing. It started out with no load index mutual funds, and of course now has gone into index ETFs, essentially saying not only can you as an amateur not beat the market, the index funds, but the professional managers can't either. So the best choice you should have is to invest in the index. And of course, there we're doing 4% better than the index. So that's not anything radically different than you were saying, but I just wanted to kind of point out you were stressing us as armchair amateurs, which we are, but the professionals can't do it either.
I don't like to say things like that, Si. It could be perceived as being nasty sometimes,
I said it kindly, didn't I?
We don't want to poke the bear very often. So.
He was pretty diplomatic. I mean,
yes, he was extremely diplomatic. Yes,
it is a subject we cover every Tuesday at 2 at our bull sessions, and we point out that Indexville, has a certain return to it, but the companies like you see here in this top 20 list for the roundtable are frequently populate our efforts, and very, very often there are no guarantees in this business. Anything can happen, as my performance over the last year has demonstrated. But we pick some fairly decent stocks from time to time.
Well, and by weeding and feeding, I guess what I'm speaking about is our tendency to fall in love with a couple of our stocks, and maybe we have to find a way to divorce a few of these, even though they've been tried and true to us for so long. When you get down to a sales number that is down around 5 or 6, and a return number that's under 5, maybe you have to break the marriage up at that point. So we'll take a look at some of those stocks and maybe bring them to you and see what you think.
Just real quickly, just in case, there are some new names on the roster tonight, so you can access the entire set of listings, the entire set of positions for the roundtable tracking portfolio using that internet address on the upper left. That is a public link, so if you enter that link in, you'll see all of the current active positions. The legend on the upper right tells you how many times a particular stock has been chosen. Anytime we make a choice or a decision, we invest $1,000 into that position. So Ken mentioned Microsoft earlier, and we showed you the 5 positions 2 slides ago. For Microsoft, $5,000 has been invested, and it's now worth $109,000. So that legend up at the top will tell you how many times the individual entries or companies have been selected. Anything else, Ken? We want to keep driving that return up.
Absolutely, absolutely. So I think it's time for us to, Fritz would like to know how many positions are in the portfolio. Mark, can you give him an approximate number of the positions in the portfolio at the present time?
Rough number, approximately 80-ish active positions.
And again, Fritz, if you go to that link in the upper left-hand corner, you'll see each one of the stocks that we own, and then you can put that together with the repeats to find out how many actual positions there are that we dealt with then in the portfolio.
We are approaching 1,000 transactions since we started doing this. So 1,000 transactions over the last 15 years or so. So it's fun, and we do an entire session on that subject. It's really
and we
fantastic.
should say, Mark, that the majority of the transactions are buys because we buy 5 positions every single roundtable. We have at least 4 stocks that we present, plus we give the audience a chance to add a position to that group as well.
Yeah, those are
Without further ado, I'm going to introduce our guest presenter, Betsy Wills. Betsy was my driver when I visited Rocky Mountain at one time, and we had a wonderful discussion about a lot of different things. We were talking about small stocks 20 years ago, and we're still talking about small stocks today. This is a very brief biography of Betsy. She came to us at a bull session, gave us some wonderful small stock ideas when we were going through our creation of our small companies list, our best small companies list. I think Betsy is president right now of the Rocky Mountain chapter of Better Investing, and she belongs to at least one investment club. Is that right, Betsy?
That's right. I used to belong to 2, but the first one actually folded. But the one that I started in '99 still going strong, and we just passed 650,000 in assets.
Nice.
Absolutely wonderful. Without further ado, then here's Betsy Wills from the Rocky Mountain chapter presenting Powell Industries.
Thank you very much, Ken, and thanks again for inviting me, guys. It's really a pleasure to be here and to be with all of you tonight. Happy New Year to everyone. So I'm going to be talking about Powell Industries tonight, and Powell is a stock that I presented at Bink. I had the opportunity to participate in the BI Gals Talk stock with Kim. I don't know if she's here yet tonight or not, but that was a real privilege, but I did talk about that. I do own the stock. I've owned it for about a year. Next slide, please. So just some brief background information to get us acquainted with Powell. It was founded in 1947 and its headquarters is in Houston, Texas. It used to be a small company, but now I think it's grown to be a medium-sized company. It plays a vital role in energy distribution, and we'll talk more about that as we get into this. And it's number 10 on the Forbes list of most successful small cap companies in 2024. The graphs on the right, I couldn't find similar graphs. Their fiscal year has ended. The 2024 fiscal year has ended, and so these are just third quarter graphs. But I don't think that they've changed much really for the whole year. On the top graph, you can see that they're pretty much 84% of their business in the United States, and that in the lower graph, it's the revenue by sector, and you can see that almost a substantial portion comes to the oil and gas and petrochemical sectors, and then followed by the electric utilities. Next slide, please. So just briefly looking at the numbers for the year, their revenues were $1 billion. It was a 45% increase over fiscal year 2023. They had a gross profit of $273 million, 27% of revenue. Net income of $150 million, increased 105% year over year. New orders totaled $1.1 billion, and importantly for those of us in better investing, they have no debt, which we'd like to see. Now, the chart on the bottom on the right-hand side is their margin chart, and it shows that the company is really becoming more efficient as the time goes by, and particularly the jump between 2023 and 2024 is considerable. They do have a net cash position of $158 million, so they can finance their growth organically, and management is good at creating value. I mean, they've been around since 1947. So next slide. So before we get into what they actually do and how they participate in electrical distribution, we need to take a little step back and talk about the war of the currents. And I thought this was pretty interesting. So we all know that electricity is measured in volts, right? So it's got to be mild enough to avoid killing or injuring people and critters and things like that. But the excess of the voltage can also burn out equipment. Now, there are two ways to generate current. We're talking about the late 1800s here. So Tom Edison was a proponent of what they call direct current, where electricity always flows in one direction. It was milder and safer, but it couldn't travel very far. So you'd have to have a number of power plants. Westinghouse was a proponent of alternating current, and where that is, electricity always flows back and forth. Now, it's really powerful and it can travel far, so power plants can serve distant locations, but it's potentially very lethal. So next slide. So well, there was a number of different tests that were pretty gruesome between the two current types, but ultimately Westinghouse came along and built the first transformer to control electricity. Now, transformers connect circuits to one another, and they step up voltage up or down as needed. And it allowed the AC, the alternating current, to be safely used on a mass scale. But the problem is they're very expensive. So we use switchgears. And switchgears really are electrical traffic cops. They accept voltage entering a facility, typically a utility or a substation. They divide it up and route it along different pathways. and they facilitate problem solving. They have circuit breakers and fuses that cut power when the safety needs so require. And they also have some analytic capabilities. So if you think even of your own house, think of how many switches there are in your house and the power that comes into your house and how it's distributed around your house. So with that, next slide, please. Enter Powell. So what Powell does is they design, develop, manufacture, and service these custom engineered equipment and systems that distribute, control, and monitor the flow of electrical energy, then provide protection to motors and transformers and all these other types of equipment. The switchgear routes, manages, and controls electricity, and it focuses on low and medium voltage applications. Now, the products are complex, and the key here is that they are engineered to order. They're custom made. They're a tailored product, which is attractive to the clients. Switching is a complex process. Different customers need different devices. So they focus on breakers, switches, grounding tools, chargers, and industrial scale and electrical management hardware. They have a strong moat, and they're the only listed company with a high concentration and exposure to switchgear. Next slide, please. So this slide shows you their primary end markets. And as we talked about, the oil, gas, and petrochemicals is the largest part of their revenue stream. They do liquefied natural gas, refining, petrochemical pipelines, biofuels, hydrogen, carbon capture. They're involved in, their products are involved in all those things. They also are involved in the industrial and commercial applications as shown on the right-hand side of the slide. The industries that require or produce large amounts of electrical energy, such as utilities, transportation, particularly light rail, metals and mining, pulp and paper, and data centers. And by the way, if you're looking for a way to tap into the data centers, this is one way. Others might be looking at companies that are constructing the data centers, companies that are actually supplying the power. I think Vistra is one of those, if I'm not mistaken. Okay, next slide. And so this is kind of an interesting chart. It kind of shows you how the electricity is created either from solar, wind, fossil fuels, hydroelectric, or nuclear on the left side of the page. And then it comes in and it flows through, and eventually flows through the power lines that go to the power stations and then out to the power lines that in all of our neighborhoods. And from there, from the power lines in our neighborhoods, it goes through these transformers and switchgear down to industrial, commercial, residential, transit, and sustainability products. So I thought that was kind of just a good diagram to illustrate where they fit in the whole process. Next slide. So why is it a growth stock? Well, obviously, it has a healthy balance sheet, as we saw earlier. They have a pretty good order backlog. They have the strong economic tailwinds from megatrends that I'm going to talk about in a minute. The Trump administration has promised a drill baby drill, and drilling companies need large and these custom designed electrical distribution systems to power their drills, sensors, motors, and all of those kinds of things involved in oil and gas production. And Trump has also promised to reduce regulations to incentivize more American energy production, which should result in more business for Powell. And interestingly, the demand for electrical energy is expected to grow from 25,000 terawatt hours in 2022 to 36,000 in 2030 and 71,000 in 2050. So you can see there's going to be quite a demand for electrical energy, and that all has to be routed and taken care of and distributed. And that's what they do. Next slide, please. So I mentioned the megatrends. So Powell is in the middle of three of the largest megatrends. The first one is the transition towards clean energy, and the oil and gas industry is getting increasingly electrified, and especially in the Permian Basin, and they're right down there in Houston, right next to that. The AI industry. The data centers, as we mentioned, need to power their workloads. AI is forecast to quadruple historic rates of electricity demand. The cloud data centers, crypto mining operations, EVs, EV charging stations, wearables, smartphones, Kindle, laptops, everything has to do with AI. We'll have to deal with this problem about energy distribution. Go ahead. The next one is the reshoring of American manufacturing. About 18% of the announced projects have commenced building, leaving 72% of the projects still in the planning stage and need a 3 to 5 year lead time for electrical components for those projects. And the demand for these electrical projects is creating a significant shortage of transformers and switchgear throughout the United States. New domestic gas power plants to satisfy growth in electricity demand and electrification of oil and gas will continue to drive that demand. Next, please. So there are also some new developing market opportunities for Powell, which also leads it into being a growth stock. There's several here on their near-term opportunities in the automation industry. The biofuels and biodiesel, particularly the renewable energy, continues to grow. The energy shortage that we've talked about, distributed switching applications, battery storage technology, and so on. The longer term, looking out longer term, they are going to be involved in or planning to be involved in the carbon capture and sequestration area, where they move compressed CO2 from the permanent underground storage, and that requires a complex distribution system for sure. And then hydrogen, of course, supporting the safe and efficient production of hydrogen fuels. Next, please. Now, this stock chart is interesting. So you can see that it hit a high of about $365 a share in November. Today, it's at $228, so it's come down quite a bit. The 52-week low was $76. Now, I've done some reading on why the stock has been coming down, and it looks like there's a couple of reasons that I've been able to find. There apparently is a high short interest out there, and the backlog that they announced, even though it was about over $1 million, it didn't increase as much as it was anticipated due to customer spending, and so that has some people concerned and some selling, and probably year-end selling as well, because it's gone up. You can see that it just went up like a cannonball, really, from well, and the chart doesn't show you earlier in the year, but remember, Bink was in May, so the price was way down when we talked about it at Bink. But this is going to come into play when we talk about our SSG. So keep these figures in mind, that the high was 365 and low was 76. Mark the next chart, please. Mark?
Did you?
Can you give me next? Yeah. Can you go forward?
It should have switched. Did it not?
It's not showing switched on my screen.
I'm switching here. Ken, can you confirm it's locked up on your end?
It hasn't switched on. It hasn't switched on my screen. There it goes, Mark.
I think go back. I think is that the next one?
The next one is
okay.
mindset.
So,
okay.
Yeah. Okay. So I always like to talk about what your mindset should be when you're talking about investing in these small stocks. And this is not your rent money. This is something that in my club we always talk about, that what we're doing is not our rent money. This is not money that we need for anything. We don't need it for college, travel, medical, or whatever. And if we invest in some small stock, we have to be able to ride the roller coaster. We have to be able to sleep at night. And we, as my yoga teacher says, you need to be able to be at ease in the midst of all things. Next slide, please. Okay. And also remember too, and we'll when we get into the SSG, keep these points in mind as well. When you're investing in companies that are not profitable, or they're profitable but they're have a high valuation due to high expected growth companies, you're really buying into the company's mission, the vision, the leadership, the innovative ability, and the growth potential. And that's sort of akin to Jeff Bezos' philosophy, where he said, given a 10% chance of 100 times payoff, you should take that bet every time. And he's also been known to make his investments based on if it's going to change people's lives. And that's kind of what we're talking about here. And again, you buy and hold for the long term until you become disillusioned with the mission of the company or the vision, or that you no longer see that it's aligned with your values or your goals. But the potential returns can be extraordinary if you make the right call and hold for the long term. So let's next move to, I think the next slide is the SSG. Okay,
Yep.
Here we go. So you can see here that, again, we've seen the charts we've already looked at. We can see that the earnings, per share profit, sales have all dramatically gone up, particularly those two bottom lines. Let's see here. I guess I can't really read the bottom part of it, but I can't. Can you show the bottom part, Mark? It doesn't show my projections.
Your screen must be cutting it off. We show estimated future.
Oh, you can. Are you seeing it? Okay. Okay.
Yes. Sales growth at 9.
Well, I'll just
go ahead.
No, go ahead. I can't see them. So, sales growth at 9 and
EPS growth at, call it 7%. So.
Okay. So what I did here was I took a look at the value line, and Cy and I had this discussion about using looking at the actual numbers on the right-hand side of the estimates in the chart of the value line. So I pretty much approximated those numbers to get to my 5-year projected numbers. And you can see that I'm pretty much in line on the sales figures, at least for a couple of years out, the estimates, and I'm a little bit below what the analyst estimates are on the earnings. Next page, please. Okay, now looking at the management's top in section 2, you can see that management has done really well. The pre-tax profit on sales and the percent earned on equity have dramatically increased and have done very well. The debt, they show a little bit of a debt, but it's nothing, even if it's, I'm not even sure what that debt is because it has no debt. Looking at section 3 then, again, we see that the 52-week high is about 365 and the low is 76. I have eliminated as outliers a number of values in the chart itself because they didn't seem to fit in their outliers, and it didn't give me a good feel if I left those in as to reasonable numbers. Moving down to section 4, you will note that I went with an average high PE of 25, which gave me a forecasted high price of 425. Now, here I need to divert a little bit and tell you that for, again, the high price, it's already hit 365. So the value line, their high price that they were projecting out 5 years was 335. Again, we already passed that once. The Morningstar, it's not covered there, but they do consider it to be overvalued at this point. Manifest, Mark, I think you guys are projecting a 317 for a price. So that's the problem, is that all these prices have already been exceeded by this company by its 52-week high. So the question is, again, going back to, are you buying into the vision? You're looking at the future, looking at the demand for energy. Is this something that you can foresee a price that will double in 5 years? And my projected price of 425 is not quite a double, but that's the idea. That's why it makes sense to me. The low price, okay, is I went with 200 and that just, again, it seemed to make sense. I don't think it's going to drop that low, but anyway, it just seemed to make sense to me. So if you go, I think maybe the next page, it gives us a upside downside ratio of 6.2 to 1, which is a pretty good upside downside ratio. And our potential, our 5-year potential is about 8 to 13 or 13.6%. So that's where I got to buy. If we liked it at 3, when it was at the high, if we liked it there, we'd really like it at 228 or whatever it is today.
Well, thanks, Betsy. I think it really comes down to if you believe that that's going to stick and continue to, there's going to be persistent in that, rather dramatic uptick with all the growth potential areas you described is really what you're getting at. If that stuff all goes away.
And I think that, yep. But again, it's, you look at the things that we mentioned earlier, the quantum computing, the modular, nuclear, what do you call those, Ken?
Reactors.
Small, yeah, SMR, small modular reactors. I mean, all these things, the rare earth minerals, it all just seems to be, to me, I mean, I'm pretty optimistic as a person in any event, but I see that there's a lot of potential here for all these kinds of new things, and I think we have to be part of them.
Yep. And
Betsy, we're getting questions from a couple folks in the audience. Shirley and Robin both would like, can you point to any competition for Powell? Do you know of any companies that compete either partially or fully with Powell?
There aren't any companies that have the same kind of exposure to transformers that Powell has. There are a couple of other ones out there, but I cannot tell you the names of them right off the bat. They're bigger. They're all bigger than the small company or small middle-sized company.
Okay, and Ken, she did mention the word hydrogen, so do we have to towel you off so you can continue, or?
No, I'm all set. I'm feeling good about it.
All right, well, thank you, Betsy. We can come back to other
Absolutely.
questions at the
Thank
end.
you.
Take us away with Schlumberger, Ken.
Well, I presented Schlumberger on July 30th, 2024. That's why you see the date here on this particular slide. And I'm going to present it again tonight, and I'm going to try to contrast and compare what I presented 6 months ago with what I'm showing you tonight. I still think that Schlumberger is a great idea at the right time. Betsy gave you some really great reasons why it might be why Powell might be a growth stock, and I'll take 2 of her reasons and tell you they're the same as why Schlumberger might be a great growth stock. If we're going to do more drilling for oil, whether it's in the US or around the world, and if we're going to be reducing regulations in the United States to encourage energy production, then I think Schlumberger is well positioned to grow its business as fast as it possibly can. It's the largest provider of oil field services in the world. And I can reduce it to just a very simple statement, which is, if it's done anywhere near an oil field or anywhere near they're transmitting oil from one place to another, or anywhere near they're contemplating drilling, or anywhere near they're cleaning up drill sites, then Schlumberger probably is involved with equipment to help in whatever the process happens to be. They are that diversified and they are that ubiquitous throughout the entire world as far as petrochemical discovery and recapture is there. So Schlumberger is the biggie. It's the big elephant in the room. It does have direct competitors, and most of you know some of the names of those direct competitors. Schlumberger has been working diligently to expand its margins. So as it moves into every different asset or every different component of dealing with the petrochemical industry, it is especially focused on places where it can expand the margins, on places where there's a lot of money to be made in competition with other companies or in creating new products or new processes for existing companies to use. This margin expansion can be seen in all of its numbers, and it can be seen in the growth that's been going on in Schlumberger since the end of the pandemic we'll call it the end of 2020, maybe the middle of 2021. Next slide. They're working EBITDA, earnings before interest, taxes, depreciation, and amortization, very similar to pre-tax profit, if you will, little bit of differences, but very similar. And they're working to exceed what they already have been able to accomplish. They've been able to already move to something around 20%, and they'd like to even make that go higher as we move into 2025 and beyond. So again, there's this increased focus on actually taking and moving everything as that they can to the bottom line of the balance sheet, and then of the income statement, and then helping some of that money flow directly to the shareholders. Next slide. This just says the same thing I've been saying before. A huge dependence on bringing AI into the field of petrochemics and leveraging that technology to become more efficient and to drive the producing the petrochemical down, which of course raises the profit margins. And next slide. Here's the SSG. You can see that shift in philosophy starting at around the middle of 2020. It shows up in the 2021 fiscal data, and then it continues to show up in that very nice, neat from 2021 through 2024. The progression out into as projected by almost everybody that you can talk with, seems to be maintaining itself, and yet it's almost as if the market is saying we don't believe anything that the company or that the analysts are telling us, because the company is not being rewarded for increasing profit margins. It's not being rewarded for increasing debt on return on equity. It's not being rewarded for reducing their debt. It's not being rewarded for any of the things that we usually reward a company by increasing its PE ratios. I've read a lot of analyst reports on Schlumberger, and I've settled on growth numbers. Today, I'm comfortable with growth historically for sales at around 12% for the next 5 years, and earnings growth at around 14% for the next 5 years. Next slide, please. Here I've truncated down to just the 21 through 24 data, and you can see the numbers, the averages for the last couple of years have changed quite a bit. and they're moving in a very, very positive direction. Look at the evaluation of management. You very rarely for a company this size see everything all green, and yet this company is moving very green in all the areas. Even the debt is moving down back to acceptable levels, the same place that they were 8, 9, 10 years ago, into much more acceptable levels that we can say are at that 33% or less value. So I've moved my sales growth down 2 points from where I was in June. I've moved my earnings per share number down 1 point from where I was in June. And that's my SSG at the present time. Next slide. I've gotten some more quarterly numbers since June, and they've been extremely positive. And yet the market continues to move the price of the stock downward, which means that the PE keeps moving downward. The 5-year average PE for this large company was up around 19. The current PE for the company is down around 12. I've moved my anticipated PE values from 22 and 12 down to 18 and 10. In other words, I'm lowering the hurdles that the company has to jump over in order to make the par that it's going to show me in section 5 of my SSG. I'm putting up lower hurdles, less resistance, and I'm looking to see where the par is going to be at these lower PEs, and along with lower sales and earnings numbers. My average going forward now is around 14, which is right in the middle of the pack for the companies that are calling a long-term PE out there. You can check on long-term PE and Value Line, Manifest Investing, and there's 2 or 3 other sources where you can find it as well. These values that I've given you come up with a buy with about a 10-to-1 upside downside ratio. I think that's pretty healthy. Let's look at the next slide. When I fill in a payout of about 36%, and that's about a 2%, maybe a 2.5% dividend yield. That's a pretty decent dividend coming from this large company. I'm getting par numbers of about, and I do have a typo that should read at the bottom in the box down there. It should be 19.8, not 19.2. But I'm looking at about 20% to about 25% par for this company. The last time I did the SSG, my par was just under 19%. So I haven't really changed the par value very much with these lower PEs because I have lower prices to go along with them. Next slide. Here's the manifest scorecard from last Friday's close. It closed at $37.80. Manifest gave me a par of 21%. Remember, I was calling around 20. And in July, Manifest was calling for a par of around 18%, not dramatically different. And again, I think that I'm in the right ballpark, whether I'm looking at 6 months old data or whether I'm looking at the most recent data. One more slide, please, Mark. Morningstar saw the company undervalued when it was trading at around $48, and it finds it very undervalued now when it's trading at around $38. Notice it's changed its fair value just a touch from 60 down to 57, down 5%. So it still finds the stock extremely undervalued, 33% discount. I'm looking at the future target prices from Value Line 6 months ago in July, 14 to 26%, now 16 to 28%. Again, my 20% I think puts me in a really good place in these numbers and in this valuation. And one more slide, Mark. I'm very comfortable, and I'm suggesting we add another $1,000 to our holdings in Schlumberger. I think it's a compelling stock at the really beaten down price right now, and I would ask you to give it serious consideration.
Well, Ken, I'm almost expecting you and Betsy to show up on a future episode of Landman with Billy Bob Thornton. So you guys would both fit in very well on that TV series.
Mark, I'm getting some technical questions from people in the audience, and my suggestion is that if you want to find out the kinds of things SLB sells and the different percentages and everything, that you take a look at the investor presentation that's available on their website. It's extremely comprehensive, and it gives you a really good breakdown of its products. And like I said, the products are, the list is huge. And if it's anything to do with an oil field or with oil production, then Schlumberger is selling you something to do with the process that you're looking at that point.
All right. Thanks, Ken.
Mark?
Yeah, Betsy.
Mark, it's Betsy. Yeah, can I jump back in with a response on those competitor questions?
Sure.
So according to Seeking Alpha, Powell is #1 in the top electrical components and equipment stocks list. #2 is American Semiconductor. 3 is Generac, which is a name that I'm sure we're all familiar with, but again, isn't a competitor, I would think.
No.
#4 is Emerson Electric. Again, a utility, so they supply switching to those utilities. Then it scoots on down here. I don't recognize any of these names. Vertiv is in here at #10. And there's, again, I'm not recognizing any of the rest of these names. And if you look at the SSG and look at the peer group, there's something called Orion Energy Systems and Graph Tech International and Hayward Holdings, none of which I'm familiar with. So you'd have to actually look at each one of those companies to see whether they actually compete. In my experience, a lot of time, the companies that are listed as peers on the SSG really aren't comparable. So hope that helps those questions.
Yeah, they are definitely the primary. I used to work in the electric utility field, and they're definitely the ones that you're going to find as the big circuit breakers that Betsy has described. Those are great big pieces of machinery, and they're probably more than 50% of the ones that are actually installed in the United States and worldwide. So they do have competitors. I mean, you mentioned Emerson, and Square D was out there, and there's a couple others, but they are formidable, no doubt, even though they're a relatively small company in the big picture.
Betsy, our friend Len Douglas is very interested in short interest, and you mentioned that there was a lot of short interest in Powell, and he's been doing some research while the presentations have been going on, and he's going to forward his research on short interest to Mark, and Mark can then forward it on to you if you're interested in some of the numbers he's collecting about the actual amount of short interest, which seems to be driving the price down a little bit.
I picked that up as well. Seeking Alpha has a short interest graph or list, and it's definitely in there. It's not at the top, but it's definitely in there. So that's probably the same list we might be looking at if he's looking at the Seeking Alpha one.
Yeah, and
thanks, Len. We appreciate your
Thank you. Yeah.
Just as an editorial comment, I would think that would be basically an indication that a bunch of professional investors think that they got ahead of their skis, a little bit in front of their skis, and they could be right, but that's basically what they are. I'll use the term wagering with those short interest bets.
And you know,
Let's move on now to our presentation from Cy Lynch. And Cy, I know that you've brought Axcelis to us before, so tell us a little bit more about Axcelis Technologies.
All right, thank you, Ken. And I'm kind of continuing the theme that started with Powell and especially got into action with SLB or Schlumberger, looking at suppliers, not suppliers to end consumers like you and me, but suppliers, really, in fact, in Axcelis's case, suppliers to the suppliers to the suppliers, where Axcelis is as we'll see in the company description in a couple of slides, supplies to semiconductor manufacturers that, of course, then supply their chips to the cars and the phones and all the other computers and all the other things that we actually consume. Little bit of other themes that we're continuing to some extent, at least perhaps with Schlumberger. You see that Axcelis is selling at a really getting pretty close to an 18-month or so low, certainly a 12-month low. But Value Line sees a wide range of potential 3 to 5 year returns and a pretty healthy potential at 40% for the 18-month return. And that's using current price when I prepared this, which was, I think, Friday's close, not the latest Value Line printed edition. They're down actually about 10% from that price, even though it's only about a week ago old. Next slide. I just decided to look at our dashboard, rank it by total return, and look for good or better quality with significant potential return here, at least 5 percentage points above my par. And just skimming down the list, you could see it was abbreviated a little bit in the yellow zones. I took a quick look at Lamb Weston and decided to go with Axcelis. And some of the reasons that some stocks potentially on this list were excluded is I was leaning toward a 1 or 2 time pick. We didn't talk a lot about some of those few picks, although Microsoft has only been picked 5 times, and we mentioned, and is now the largest holding. One of those regrets that we didn't pick more. So I decided to go with Axcelis. I also decided that rather than trying to hype to you for your vote at the end of the night, I'm picking a stinker stock. Notice it was on the stinker list at the beginning, along with Schlumberger and Mark's upcoming pick too. So maybe I shouldn't mention that because
what you just did.
But I'm picking a stinker stock, and even Value Line's analysis wording, although you saw some of the potential numbers aren't terrible, their wording is not real positive on the stock as opposed to the business. Value Line does believe that 2025 will be a turning point positive for the business. Again, as I mentioned in some of our early discussion, the semiconductor industry generally has been really beaten up. There's a lot of uncertainty in the area because of worldwide business concerns and so forth. And we'll see a little bit of the company's third quarter report and what they said about some of those headwinds. But again, it's back to, are the problems temporary or terminal? And that's the decision we've got to make. Stinkers with temporary problems, but solid companies overall can be excellent money makers for us if we're patient. Next slide. Here's what Axcelis does. They essentially supply ion implantation equipment to semiconductor manufacturers. They also supply related products to that: cleaning supplies, equipment, tools, and measuring devices. But it's to implant ions on pieces of silicon. And they have a line of products. They're the bulk of their products, the Purion family, as they call it. They believe that they're the most innovative, as you can see on this chart. And they sell worldwide, much in the Asia Pacific area, where, of course, many semiconductor manufacturers are based. Next slide. Here's what ion implementation is. I won't read it to you, but it's a major step in changing the transistor or the silicon into transistors for semiconductor chips. And notice it also can change some of the electric composition of silicon. Again, if you're a scientist or a perhaps, no, not really physicist, chemist, perhaps even in some ways, you can get super technical, but really they make silicon chips or make equipment that makes silicon chips work. Ability to process data in the form of electric charges. Next slide. Here's just the company at a glance. They've been around for 45 years, although they just exceeded in the 2023 fiscal year $1 billion in sales. So they're still a relatively small company. Notice that they're recognized on the Fortune 100 fastest growing companies, as well as Forbes most successful mid-sized companies. Next slide. Here are some of their American facilities. Well, 2 American facilities, and then the South Korean Asian facility. So again, they have facilities, both headquarters and manufacturing related places throughout the world. Next slide. Here's what this is from I believe the earlier investment report that I presented back in actually the February roundtable that was held the first week in March, that this is what's going on. When I talked about the supplier to the supplier to the suppliers, for us, they go everything from automated vehicles or electrified vehicles, from the EVs to simply much more electronic things in internal combustion and what we'll call regular cars, as well as the automated or the driver assist systems of telephones and other Internet of Things. Of course, they've got to throw in somewhere, like just about every company, to include probably Lamb Weston's French fries, have to mention AI or artificial intelligence. And again, they supply fabricators that they believe will expand, that being their customers will expand over coming years. Next slide. Now, this is the third quarter report, and they reported a decline in revenue as well as diluted earnings per share. And they, as you can see here, they saw strong growth in image sensors, which is one category of their business. That's about 19% of total revenue, was growing strong in the third quarter, but their power and their general mature, that mature being not cutting edge technology, just I guess a good example of a mature market would be semiconductor manufacturers putting in primary chips into phones, or even just memory chips, SRAMs and DRAMs into computers. They also, their bookings lowered some in the quarter, as here their wording is customers digest investments in capacity. Essentially, their customers got ahead of themselves. Again, if you think about some of the areas that they mentioned, phone sales are stabilizing among many of the phone manufacturers, of course. Both automated driving equipment in vehicles as well as EVs are also moderating. So their customers maybe got a little ahead of themselves. But again, it's a growing field. And then they had a little bit of favorable earnings per share impact from non-recurring items. Next slide. Again, this is talking again a bit more about the customers needing to catch up to their investments, essentially be able to fill their capacity. But the long-term growth still remains intact. Memory in general, mature markets, they expect the recovery, their advanced logic, and then they are expanding into Japan, which is a new market for them, although they've been in other places in the in Asia. Next slide. Here is our stock selection analysis. You see consistent historical sales growth, although in 2023, as you saw in the chart on the first page, there's been a bit of a dip. Historical growth of over 18%. I'm projecting around 6.8 going forward. But notice in the evaluating management side, both a declining debt to capital. They don't have a lot of debt and it's going down. But notice those very strong return on equity in 2023, 30%, and strong profit margins that are increasing as well. Next slide. This again too is their investment. Why management believes that you should invest in them. Again, the mature process is continuing to grow, and as kind of we alluded to earlier with their Purion systems, their implantation equipment, they're market leaders in both mature as well as the high growth specialty markets. Next slide. And then here are my judgments. I mentioned the sales growth projection of 6.8%, and that's in line with the Value Line and other analyst projections. Projecting the profit margins to stay about the same, although they have been increasing. So we might be pleasantly surprised if that continues, but it's kind of tough when you've had profit margins more than double in the last 3 to 5 years. That's not likely to keep going, but if they can sustain it, and management is buying back shares, which should boost the earnings per share a little bit. I'm projecting a $9.98, roughly $10 over the next 5 years. That's a little below the manifest consensus you could see, and a little bit above the median of other members of Better Investing who have done an SSG on Axcelis. Biggest thing to realize about Axcelis is it is volatile, and volatility can move down, and so there is a chance of sleepless nights. On the other hand, volatility in the right direction is very exciting. So next slide. Here's the potential upside of that volatility. Total return of between 17.5% using the average PE of 16, or 26.4 using the projected high PE on my stock selection guide. My judgment And that's to be compared to the manifest par, which is still very solid at 14.8, based on the higher growth, both of sales, and you saw the earnings comparison on the previous slide. But manifest consensus is projecting a little bit lower PE than my PEs, but neither really looking at the analysts nor looking at history can I right now justify significantly lower PEs, but we'll see how it goes. Even, like I said, at the manifest lower PEs, you still get a very solid 15% return. So I'm going to double down my February/March purchase of Axcelis.
Well, thank you, Si. One of our buttonwood stocks. Speaking of buttonwood, we do the Tuesday bull sessions. We'll be out with a calendar for 2025 as soon as I can figure out how to talk to the people to do that. Good stuff. All right. Well, Si has already taken away all kinds of the thunder that I could bring. Yes, this is one of those stinkers, a selection that's been made fairly recently that's not performed very well, but we look at that as an opportunity to accumulate in many cases. And what I'm showing here is this is a forum entry at Manifest where Matt is basically sharing some results of some tests at Novo Nordisk. The ticker's NVO. It's one of the obesity drug suppliers. And this was actually a fairly insignificant test. But what I draw your attention to is I have a lot of trouble with this as a statistics person, differentiating between 22.5% of body weight versus 20%, 25% for the goal. To me, those are the same numbers. So I don't, that's not something that you should go into a shrieking frenzy over. There's certainly nothing really weird. And notice that their competitor, Eli Lilly, is at 23%. Again, that's the same number. I just continue down the page and I see, well, heck, half of the people that were involved did achieve a 25% weight loss. And I'd like to achieve a 25% weight loss. And to have a 50% chance of doing that would actually seem pretty good. The guy in charge for Novo was encouraged by the data. So I'm having trouble seeing how that is exactly catastrophic news. Here's a look at the price chart. They've been having dribbles of this for the last few months. Slightly disappointing results of testing and operating results has been getting punished, much like the stories you've heard from Ken and Si with the other stinkers presented. But again, this is an opportunity for a longer term situation that's trading down at a significant discount to where it was 6 months ago. And maybe it is just a breather along the way. They're one of the two most significant providers of the GLP-1 obesity medications. So I look at this and again, come back to size. Is this temporary? Is it terminal? These guys have been present in that particular market for a century. So, I mean, none of this stuff is new to them. And I just look at the bigger picture situation here. We got involved with this one because of this reality. And, I'm in this too. I mean, I need to drop down a few pounds, and I can attest to how difficult that can be, how challenging that can be. And both Eli Lilly and Novo have been pretty successful at helping people achieve better results. So the bigger picture is completely unchanged from my perspective anyhow. I would argue from the perspective of many. So again, a short, sweet presentation, very high quality company. Because of the reduction in price, the sluggishness, it is continuing to trade at a multi-year high return forecast. You see the green arrow there. It's basically up in that very attractive zone. It's visiting return forecasts that it rarely does. Much like Betsy's story, this took off with the GLP-1 drugs a couple of years ago, and I would argue is pretty much sustainable. There's a very strong core here with the diabetes, insulin medications, and their total suite of products. You can see that there has been a gentle inflection to the upside with their earnings per share trend. So I look at a company again in the mid-teens for growth and very consistent profits, fairly normal PE ratio, and a return forecast in the low single digits. I just think it's a pretty powerful potential for a longer term core holding. So I'm going to say let's go ahead and add another 1,000, make it the 7th time selection, and with the audience vote, perhaps the 8th. You can see that it's been successful over the years. Our nurse, Damsel, Kim Butcher, selected it a couple times back in the better part of 10 years ago. You can see that the 4,000 invested by Kim and the audience is up to over 17,000. So I'm hoping that my piece can also achieve results like that over the longer term. And again, the longer term picture is just to give it some perspective. It's dipped down. You can go back to 2017 when Kim became interested, end of 2016, and we kind of have a similar situation now. So I'm going to say, let's go ahead and keep accumulating and keep that as a strong component of the round table tracking portfolio. So there you have it, Ken. Continue.
Thank you, Mark. I'm going to launch the poll. Folks, we're going to ask you to pick one of the 4 presentations as your favorite. And if you don't have a favorite, pick none of the above. We'd like you to vote and tell us which one you think should add an extra $1,000 to the portfolio. We'd love to get 85–90% of you voting. We just hit 50% voting in our audience, and we have a nice size audience tonight. So let's give you just a few more moments. We hit 70%. Just pick one and mark it, folks. Doesn't cost anything. You can't vote more than once. We just went over 80. Keep voting, folks. We'd love to get over 90 if we could. It's moving, but it's moving slowly. I'm going to count to 10 in my head. We've given you a minute, and we haven't quite hit 90% voting, but we are darn close at 88%, 89%, and I'm going to close the poll, and I'm going to share the results, and we are going to pick Powell Industries. Betsy, the audience picked Powell, with Schlumberger as a very, very close second. So we'll put $1,000 into Powell along with the $1,000 that came with the original presentation. Mark, any comments for us?
Well, it sounds like they'd rather go with the damsel from Denver, versus the stinkers.
That's right.
In the hot tub. We're getting kind of pruny, by the way, in the hot tub.
Yeah. But notice I prevailed among the stinker of stinkers. So.
All right. I'll continue with just our reminder that we do archive all of these sessions if you want to go back and look at a particular company or a particular theme. The bull sessions and the roundtables are available at YouTube. If you just search on Manifest Investing and Roundtable, for example, or bull sessions, you can find that. Betsy was involved with those sessions back in October as we were picking the small companies, best small companies for 2025. So you can find her contributions back at those end of October presentations. And Ken, I believe we'll be back with the roundtable in January. Your second, or the next presentation being January 30th. I believe I have that correct.
For bull session you're talking about now, right, Mark?
For roundtable January 30th.
I'm sorry, roundtable. I'm double checking the date, Mark, just to make absolutely sure. And Mark, I have January 28th.
Great. I probably looked at
Well, the 30th is a Thursday, Mark, so I think it's the 28th, okay?
well, you know, Ken, what I basically was doing was, just making sure that everybody was paying attention.
Okay.
So January 28th, everybody.
I taught school long enough to hear that excuse before, okay?
So with that, let me go ahead and get us back on track here, I think.
We're getting a question from Robin. Is there a bull session tomorrow? No, Robin, tomorrow's New Year's Eve and we're taking the day off. Our next bull session will be the first Tuesday at 2 o'clock in the afternoon, the first Tuesday in January. And I do believe that's the 7th of January, the first Tuesday would be.
Yeah, I think that's right. You might be off by a day, but next Tuesday, not tomorrow.
I'm looking at a calendar, so I'm pretty
Okay.
sure I'm correct. Okay. So with
All right.
that said, who are we looking at here, Mark, besides damsels and knights?
Well, we're just, you're expecting snow in Michigan, right? And this is just our holiday card saying Happy New Year to everybody. It's been a good year for most of us here, and that's all we really want to do. Say Happy New Year and press on. I'm going to go catch up with my Detroit Lions.
Well, Happy New Year to you all then, and thank you, Betsy. Thank you so much for being with us tonight.
Thank you
A
for
shout
having
out
me.
to Kim and to Matt that joined us in the back room during the sessions. Thanks for coming, guys. And Cy, as always, you are greatly appreciated. And Mark, you know how much the Mid-Michigan chapter and all the folks in Michigan appreciate your work for them and
Most welcome.
and keeping us informed and everything else. So with everything going well and the year going to end, no Santa Claus rally, it appears, but it's been a good
tomorrow.
year regardless. But we still have do we have half a day tomorrow or a full day tomorrow? I'm not sure.
I think it's a full day, but it'll be interesting
Full
to see
day
if there's
tomorrow. Okay.
could be a pretty good crunch tomorrow.
So we'll wish our audience a happy new year and we'll close everything down. Happy New Year, folks.
All right.
Happy New
Thanks,
Year.
everybody. Happy
Thank
New Year.
you.
Take care.